It's actually a very interesting question because in Australia, a lot of investors have previously invested in the share market for income. I would argue that you invest in equities or the share market to participate in the growth in earnings of the company and hopefully the capital value. I believe that an investment in debt, particularly secured private debt, delivers a lower risk means to an attractive income than through equities. And the reason for that is equity is the asset class that is at risk of first loss in the event of a deterioration in the financial performance of a company. The provision of a loan gets the benefit of the equity cushion or the degree of security and structure around it. So if I think about what investors experience, both at the time of the global financial crisis or at the time of the pandemic, a lot of companies undertook deeply dilutionary equity raisings, destroying equity value for investors that were existing shareholders as they faced dilution. But also in that environment, what companies were also doing was reducing or cutting their dividends to protect and preserve their cash and liquidity and giving priority to their debt holders. And so again, if you think about where we sit in the capital structure, debt is a lower risk asset class than outright equity ownership, and the controls that a lender can impose on a company means that a company can be restricted from paying dividends unless they're complying with their terms and conditions of the loan agreement that they have with a lender. And so lenders and the debt asset class ranks in priority to the interests of equity. And as a result of that, I believe that it's a more sustainable and more stable means to generate income from debt than it is through an investment in equities.